Hey YouTube, Matthew Decker here, Leveraged Wealth Management. I hope that you're doing well today. This video is actually brought to you by Brian C. Brian emailed me a week or two ago about asking for a review on the North American Builder 3 product, which is one of their new products that just recently came out, and it conforms to some of the new 7702 rules. And so since it's been a while since I did a product review, I thought it was a great place to start. I've reviewed North American products in the past. They're a great company. They've had some phenomenal products. This new one's a little bit different, and so it's a great product to review. Because it's a little bit convoluted with some of the new rule changes, I'm going to first have to set the stage. So we'll start on the whiteboard. I'll tell you exactly what we look for when it comes to these IUL products, and then we'll get into the product review. And I'll go ahead and put chapters to this video, so if you want to skip ahead, you can do that. So let's get on over to the whiteboard and talk about exactly what we look for when it comes to these indexed universal life insurance contracts. So when it comes to evaluating these different indexed universal life insurance policies, since they're changing all the time and there's a lot of different industry lingo, we really like to look at four core things when it comes to evaluating these products, and we'll write them on here. So the first thing that we like to look at are, number one, crediting rates. And into crediting rates, we will also put index options. So when we say crediting rates and index options, what we really mean is, number one, what type of track record of performance does the product have? Number two, what do the caps look like? What do the rates look like? And then number three, is there a diverse selection of index options available, or do they really kind of force you into one index in order for the product to work and look attractive? And so there's a lot of companies that will, force you into one index because all the others are unattractive. And then there's other companies that have maybe 4 or 5 really good options for you to choose from. So that's the first thing that we're going to look at, the different crediting rates and the index options available on the policies. The next thing that we're going to look at is, does the policy have any bonuses factored into the illustration? And so that can come in really two forms. There's a flat rate bonus, and then there's also a multiplier. So we'll just put X there, multiplier. And so the way that the flat rate bonus works is very simple. They'll say something like, starting in policy year 1 or starting in policy year 11, we're going to add a 1% bonus to your crediting rate. So if you get a 7%, we're going to add an extra 1, you get 8. So that's the flat rate bonus. Very simple, very straightforward. The multiplier, I believe, is also pretty simple and straightforward. They simply say, if you get a 7% rate of return or a 10% rate of return, at the end of the year, we're going to multiply that return by some percentage. So you might get a 1.15 multiplier or a 1.5 multiplier or a 1.4 multiplier. Doesn't matter what the multiplier is. The point is, they take your return, they multiply it across a factor. And so the way that these two work differently is, in years where you get a 0% return, the flat rate is still going to pay out because it's a flat rate bonus. So if you get a 0% and there's a 1% flat rate bonus, that 0 turns into a 1. On the flip side, 1 is the best you're ever going to do in terms of a bonus, okay? The multipliers, if you get a 0%, 0 times your multiplier is still 0. So in the years where you get a 0, the bonus doesn't pay out. In the years where you get big returns, those bonuses could be 3, 4, 5, 6, 7. They could be a lot in terms of what you're getting on a yearly basis in years where you hit big returns, okay? So those are the two different bonus types. But when it comes to these different bonuses, you can have a flat rate, you can have a multiplier. The question that we like to ask is, whether it's flat, whether it's a multiplier, is it guaranteed or is it projected? And that's a huge question that you have to ask. And if you're purchasing one of these indexed universal life insurance products that has some of these bonuses, the very first question that you need to ask is it a flat rate bonus? Is it a multiplier? And then the next question is, okay, and is this bonus guaranteed, or is it just projected and they can change it on a whim? Okay, so is the bonus guaranteed? That's something we have to know in order to really evaluate this policy. The next thing that we like to look at are the loan rates, okay? Because yeah, this policy might build cash really well, it might grow, but how do we access our dollars? And when it comes to loans, there's 3 basic types of loans. There's something called a wash loan, we can have a fixed loan, and we can have a variable loan. And so when it comes to these different loan types, the wash loan is very simple to understand. They're going to credit you 2, charge you 2, or credit you 1, charge you 1. The point is what they charge you is washed out by what they credit back to you. And so it's a net zero cost loan. Just about every company has a net zero cost loan starting in year 10. Okay, so that's the first thing. The second thing is a fixed loan. It might also be referred to as a fixed participating loan, which is they're going to charge you a stated interest rate. Maybe it's 4%, 5%, 6%. It's always going to be that 4, 5, or 6, whatever the product and company has determined on the front end. But then they're going to credit you back whatever your policy credits. So if you get a 10% credit, they give you a 10% credit even on the outstanding loan balance. Okay, so that's a fixed participating loan. And then we have these variable participating loans where the rate is going to fluctuate every single year. Typically, it's going to be based on the Moody's corporate bond yield. And whatever the Moody's corporate bond yield is doing, that's the rate they're going to charge you. And you still get your full credit even on the outstanding loan balance. So in terms of loans, the two most popular types of loans are going to be those participating loans, which come in a fixed or a variable variety. But when we evaluate policies, if you're going with something that has a variable rate loan, we need to know if there's a cap on that loan. So when it comes to loan rates, is there a cap on the loan rate, or can it just go through the roof? Could they charge you 12% to access your money, or do they cap it at some arbitrary number? We need to know that in order to evaluate these policies for their long-term effectiveness. And then the last thing that we're going to look at when it comes to these policies are fees. What are the fees? Are there asset-based charges? Do they charge you more for cost of insurance than some other carriers? And have they ever increased their fees on policyholders in the future or in the past? And does that bode well for the future? Yes or no? If they've increased it in the past, that doesn't bode well for the future. So when it comes to fees, any companies that have increased their fees on current policyholders, we don't look at them. And there's really only 4 or 5 companies that have done that. And then when it comes to other things, if companies have huge asset-based charges, we really think twice about using policies that have big asset-based charges. And we've talked about that on this channel before. So these are the 4 things that we're going to look at when it comes to this North American Builder 3 product. And unfortunately, it's going to be a convoluted review because a lot of the things in here they're wishy-washy, and you'll see what I mean. So let's get over to a policy here that I've got pulled up. And we can go ahead and look at an actual example of an illustration on this North American policy. So let me pull that up here. So this is the North American policy, the Builder Plus IUL 3 that we're reviewing here. And this is a pretty standard, straightforward illustration. But I want to highlight the 4 things that we just talked about. So the first thing that we mentioned was crediting rates and index options. So what we're looking at here are the different options available on this particular product. And so we've got this big chart here of index options that are available. Let me get my pen ready. And what's important about this particular product is the only one that really makes sense to use at this point in time is this first one you see listed, the Fidelity 5% ER index. And all these other index options, they just don't really have what we look for when it comes to a good IUL policy. So for instance, we have this S&P annual point-to-point cap, and it's capped at 9.5%. Okay, so that's a relatively low cap. It's pretty straightforward. Everybody has an S&P index with something like a 9 and 9.5% cap. They've got this S&P index with a spread, which means they're going to take the first returns and give you the rest. And so in this particular instance, the current spread rate is 8.5%. So they're going to take the first 8.5% and you're going to get whatever's left over. Not that attractive. That's a really high spread. The next one on here, we've got this high par cap account. Okay, so our cap is now 8.2, and then they multiply your return by 140%. I guess that's okay. But still, it's a low capped account. We'd rather have a high cap versus a high participation rate. And then we've got this uncapped S&P. Well, in the uncapped S&P, they're only going to give you 48.5% of the credit. And so, you're getting less than half of the S&P growth. For an uncapped S&P option, I mean, that's okay, but it's just not great. Then we've just got our monthly point-to-point S&P, super risky. You can get up to 3.15% per month. And then we've got these mid-cap and the Russell. And I don't think I've ever seen anybody use a mid-cap and a Russell on this North American policy just because there are better options. So all told, what it really comes down to is if you're looking at this North American policy, the only index that I would say makes sense is this Fidelity Index because it does give you an uncapped option. It's a volatility controlled index, which are really hot right now. A lot of companies are moving to those index options, but it's the only one on here. The par rate is not as high as some other ones that are out there. And so if I was grading this on a scale of like 1 to 10 in terms of the index options that they have available to them, I guess I'd give them maybe like a 6.5 out of 10. Simply because the only one that I would want to put my money in is the first one, and all the others are not very good compared to the first one. And so if they go in and start reducing caps, reducing rates on some of their index options, I really only have one option that's attractive to me in the first place. I'd rather have 3 or 4 options that are attractive to me so that I can move money around if things change. And the one thing we know about these policies is things are going to change. They always do. All right, so these are the crediting rates that are available. Again, I'd give this like a 6.5 out of 10. Let's move on to some of the other definitions here. So I want to talk about bonuses. And this is where it's going to start to get really convoluted because this policy does have some bonuses embedded into the contract, but they just don't quite make a whole lot of sense. So I'm going to skip forward here to the bonuses and we can talk about them real quick. Okay, so here we go. So we've got this interest bonus on the indexed account. And this interest bonus is the reason that that Fidelity account is the only one that's attractive. And so let's talk about it. So they've got 2 different bonuses here. They've got the Fidelity bonus. Let me switch to my highlighter so it's easier to see. So they've got the Fidelity bonus, which is a non-guaranteed bonus of 1.65% for the first 10 years, and then 2.65% after year 11 plus, non-guaranteed. Okay, so what is the guarantee? Well, the guarantee is that it's going to be 0.5% in every year. So that should be a major red flag, because that is a massive discrepancy between what they're showing on the illustration and what they are contractually obligated to give you. And when it comes to these index universal life insurance policies, I'm a huge fan of taking everything that we can under our control and kind of leveling the playing field. And when it comes to these bonuses, we've got companies out there showing huge non-guaranteed bonuses, like this policy right here. Huge non-guaranteed bonuses, 2.65% after year 11, but only 50 basis points of that is actually guaranteed. And if we strip that bonus out, it's going to absolutely destroy the values on this contract. In my opinion, this policy is set up to overpromise and underdeliver. And so if we have a choice, you'd much rather have a policy that has guaranteed bonuses. And if they don't have guaranteed bonuses, well, then let's just take the non-guaranteed portion out of the equation so that we have some numbers that we can actually rely on, right? Because if it's guaranteed, it's contractual, we know it's going to be paid. We already know that the crediting rate is going to ebb and flow with the market. You're not guaranteed to get 6%, 7%, 8% every single year. You're going to have 0% years. And so since there's already that element that's not guaranteed, why would we layer in a bunch of other elements that are also not guaranteed, that we have no control over, and then base our planning on a policy that has 3 or 4 non-guaranteed elements to it? It's too difficult to do that. You're just setting yourself up to be disappointed in the future. Because here's the one thing I can guarantee you. This bonus that they're showing on this contract is not going to be higher than what they're showing. It's not going to be higher, but there's a good chance it's going to be lower. And I just don't like to operate that way. But you'll notice here, all other index selections, the bonus is 1% in all policy years 11 plus. So there's no bonus for the first 10 years. It's 1% after year 11. and only 50 basis points of it is guaranteed. This is the second reason that that fidelity index is the only one that's attractive on paper now. Because now we're talking about what's on paper. It's the only one that gets this massive 2.65% bonus in years 11, but that 2.65 is not guaranteed. Only 50 basis points is guaranteed. So when it comes to the bonuses on this contract, if they were guaranteed, this would be a 10 out of 10. If they were guaranteed, 10 out of 10. Since it's not guaranteed, so it's only 50 basis points is guaranteed, and since they're pushing people into this fidelity index where the majority of the bonus is not guaranteed, I mean, I'd like to give it a 6 out of 10, but because people don't read these contracts and because this product is going to look the best on paper and it's going to attract insurance agents that don't read the contracts and they're just selling what looks best, but not what's going to work best, because those are two totally different things. Selling what looks best is selling these huge non-guaranteed bonuses. Selling what works best is making sure that clients understand non-guaranteed versus guaranteed elements in a contract and having thoughtful conversations about that. But because I know that this is going to get abused and people are not going to read this section right here, it's hard for me to give this any more than I'd say like a 4 or 5 out of 10. So we'll split the difference. Let me get back to where we were. We'll split the difference and say that this is a 4.5 out of 10. Now I have to say, I'll pause here because 4.5 is obviously not a good score. This only applies to the Builder 3 policy. I want to like this product because North American is a great company, solid financials. They do right by their customers. They've had great products in the past. I work with North American. I have policies with North American with all of their other iterations of this Builder product. But this one, the Builder 3, that just recently came out within the last several months, and I'm talking to you here in July of 2021, I just don't feel good about the way that they've set this up. I feel like it is set up to overpromise, underdeliver. Let's move on. Let's move on to our loan values, because this is where, again, it just starts to get so convoluted. So we talked about how all these different companies have basically 3 different loan types, and North American is no different. So we have our standard policy loan. That's the wash loan after year 10. Don't need to spend too much time on that. They have the variable interest policy loan. So the way the variable interest loan works, like I said, it tracks with Moody's corporate bond yield. So here you can see the Moody's is right there. And this particular variable loan rate is actually good. I don't like most variable loan rates. This one, not so bad. Why? Because they cap it at 6% per year. So we can plan on 6% being a worst case scenario in this variable loan provision. I have no problems with this. I like this. It will work. Moving on. They also have this fixed participating loan, and here's where it gets weird because it's not a fixed participating loan, which again, I just don't understand why they're doing this. So we got our fixed interest participating policy loan, and when we read through this section at the bottom here, I'll just read it to you. The initial fixed rate participating policy loan, fixed rate participating policy loan, interest rate used for the non-guaranteed basis is 5%. Okay, so they're assuming a 5% loan rate. The initial fixed rate participating policy loan interest rate used for the guaranteed basis is 8%. Okay, now hold on. How can we have a different fixed loan rate on the guaranteed versus the non-guaranteed if it's a fixed loan rate? Fixed means fixed. This is not fixed, because it could be 5, it could be 8. So which is it? I don't know. And you don't know. Nobody knows. That's a problem, because a lot of people are going to see, oh, it's a fixed rate. I like that. They're going to get into it, and it's actually not a fixed rate. And so to me, this is just a problem. And if you read up here at the very top, the fixed participating loan interest rate will be declared by the company. We will notify you of any rate change at least 30 days prior to it taking effect. So again, we have this fixed interest policy loan that's not actually a fixed interest policy loan. It looks like it can go as high as 8%. They're currently showing it at 5%. But this fixed interest policy loan, it looks like it has a bonus. The initial interest bonus on the fixed interest policy loan for the non-guaranteed basis is 2%. but the guaranteed bonus is 0.5, 50 basis points. So you tell me, what's happening here? I don't know. Do you know? Is it fixed or is it not fixed? It feels like it's variable to me. Not only does it feel like it's variable, but it feels like they've tied a bonus to this loan rate that's supposed to be fixed, that's not fixed, and that bonus is also not guaranteed. So now we have two non-guaranteed bonuses in a fixed but that's not fixed loan rate. This is a problem. The loan provisions on this contract, if we just simply axed out this fixed interest participating loan, then I would say the loan rates, the loan provisions on this policy would be considered like an 8.5 out of 10, right? So if it was just the variable section, because it's a variable rate with a cap, I'd say, okay, yeah, that's like an 8.5 out of 10. That's great. Nothing to see here. This is a good loan provision. But because, again, I know how this is going to go because I get thousands of these policies a year. I know that insurance agents who do not read these contracts are going to ask their back office, give me the policy that looks the best on paper. Well, what's the best way to make a policy look good on paper? It's to flock towards something that has tons of non-guaranteed bonuses. And there's a non-guaranteed bonus embedded in the fixed interest participating loan that's not a fixed interest participating loan. And so that's what's going to get shown. And yet it's not as advertised. And so because I know that the flow of money is going to move into this fixed interest participating loan, I'm going to have to give their loan provisions not an 8.5 out of 10. I'm going to give it a 5 out of 10, and this is not North American's fault, only because I know how it's going to be sold, and I know that it's going to set up to overpromise, underdeliver. This is going long, so I'm going to try to move a little bit quicker. In terms of fees, North American's great. How about that? They've got great fees. They're one of the only companies that actually knocks some fees off their contract earlier than other companies. So from a fee standpoint, love them. They're great. Everything else on this new product, man, I just wish they would have done it differently. So let me show you exactly what I'm talking about. Let me get my face off the screen here so that I can show you some actual numbers. So what I've done here is I've got two North American policies side by side. And I want to show you the difference in all these non-guaranteed bonuses and then what happens if we strip out those non-guaranteed bonuses, because how can we rely on that? Okay, so two policies, they're exactly the same. The only difference is one is using the Fidelity account, the other is not using the Fidelity account, which strips out a huge element of those non-guaranteed bonuses. So this first one is the Fidelity account. We're putting in $70,000 a year for 6 years. Because of the way North American runs these policies now, a level death benefit on a 6-pay is going to be just fine. So that's how we're running it. And the goal is maximum income here in year 11. This is kicking out $57,300 a year, tax-free for life in year 11 using that Fidelity account. And we're using a 6% rate of return, okay? So 6% rate of return, $70,000 for 6 years. It's basically a minimum death benefit design, maximum income year 11, $57,300. And so the question becomes, how much worse does this product look if all we do is strip out those non-guaranteed elements, at least as much of it as we can? It's still going to show a 1% bonus, and only half of that is guaranteed. But one is much more conservative than 265. So what happens if we show a 1% non-guaranteed bonus instead of a 2.65% guaranteed bonus by moving the money into one of the other index selections? I would love to show you what happens. So it's the exact same policy, $70,000 for the same amount of time, the same death benefit, the same illustrated rate. The only difference is we put the money in the S&P account at 6% instead of the Fidelity account at 6%. And now our income is down to $44,760 tax-free for life. So just by removing the non-guaranteed elements, we move from 57.3 all the way down to 44.7. And to me, that's a huge discrepancy in your income. You're talking about greater than 20% reduction simply by taking out the elements in the policy that are not guaranteed in the first place. And because of that, it's just so hard for me to give this new product a good review, because I know how it's going to be sold. It's going to be sold as the Mac Daddy best thing on paper. Nothing can touch this $57,000. And the problem is, this $57,000 is based on so many non-guaranteed elements. It's not just the crediting rate. It's the fixed participating loan with the bonus embedded. It's the 2.65 embedded after year 11. Only 50 basis points is guaranteed. There's so much here that's riding on these non-guaranteed elements that I just feel a certain way about showing this version of the product, knowing that it's not going to get better than this. It's probably going to get worse than this. Because of that, if this North American product had stripped out all the non-guaranteed elements and they said something along the lines of, hey, instead of giving you 2.65 not guaranteed, we're going to give you a 1% guaranteed bonus. And instead of showing you this fixed loan rate that's actually not fixed, we just went with the variable loan rate that we've had forever that's capped at 6. I would say this product's like an 8 or 9 out of 10. Because I know how it's going to be sold, I'm thinking that this is somewhere around, done right, it can still be an 8 out of 10. But if you're trying to just win the illustration war game, then I would say it's probably more like a 6 out of 10. And that's unfortunate because I like North American as a company. I like the people that work at North American. They're a conservative company that's built on strong values, that has great financials. And unfortunately, they got caught trying to win the illustration war with some of these new legislative changes that came out. And in my opinion, unfortunately, it's going to set people up for failure. It is not setting people up to be empowered, to understand how these work and to make a good decision. It's set up the exact opposite way, which is to confuse people on how these products actually work, show them something that's not guaranteed, but it looks great on paper. And then what do you have 10 to 15 years down the road? You have less income and you have unhappy clients. And because of that, I just can't recommend this in its current form. So if you want to see more product reviews, let me know what products you want to see in the description below, in the comments below. Again, this was brought on by Brian C., who said, hey, I got this Builder 3, what do you think? And it sent me down a rabbit hole, and I had seen it before, but I haven't done a video on it. So hopefully this is helpful. The goal of this channel is really to make sure that you're not making bad decisions with your dollars. And so I would consider buying a policy that's set up for failure or set up to overpromise and underdeliver. That's making a decision with your dollars that you're going to regret ultimately. And so the reason that we do these product reviews, the reason that we're hard on some of these companies and some of the agents selling these policies is because what I want more than anything is to make sure that the people purchasing these contracts are educated. Number one, they know what the policy can do. They know what the policy cannot do. They know which parts of the products are guaranteed, which parts are not guaranteed. And ultimately, I want them to be happy with what they've purchased 15, 20, 30 years down the road. So if you want to be happy with what you've purchased in this space 15, 20, 30 years down the road, then what you need to do is you need to reach out to us. We'll set up a consultation. We call it a discovery call. We'll talk about exactly what you're trying to achieve with your money. And then we will go out and we will hunt for the very best product that's actually set up for success long-term. So it may not be the product that looks the best on paper, but it's going to be the product that's going to come through for you when you need it to come through for you. And ultimately, that's what really matters, okay? So hopefully this has been helpful. If you haven't already done so, like the video, subscribe to my channel. That way you can stay up to date on all the content that we will be putting out over the rest of this year and into the future. Leave a comment down below and tell me what videos you would like to see. Again, this came from the comments. So thank you, Brian, for bringing this to my attention, realizing that I haven't done it yet. Kind of calling me out there. I appreciate it though. And let me know what you want and I'll get to it if I feel like it's something that I'm excited about talking about and is something that needs to be talked about. So this has been Matt Decker, Leverage Wealth Management. Thanks so much for joining me. And until next time, take care.